Brad Williams, Frugal Finance, internal rate of return for holding versus sell of property. Continuation from the previous example. To determine whether it's best for the investor to hold on to the property or consider selling it, we need to take a close look at how the property is expected to perform in the future. Right now, the big question is whether selling box and reinvesting the proceeds into another property is the right move, assuming the investor is confident in being able to predict box's performance over the next 5 years. We can estimate the after-tax cash flow for years 6 to 10 as laid out in table 14.4. The investor anticipates that the rental income and expenses won't keep growing at the same steady 4% rate over the next 5 years. Instead, they project to increase by 3% annually for the next 5 years. It's worth noting from the data that depreciation charges remain steady at $8,421 per year, calculated based on the property's original cost and depreciation method in use before the latest tax legislation. This is because the property was bought prior to the recent tax changes, which didn't mandate existing property owners to switch to the new depreciable life. Hypothetical. However, it's important to consider that the investor's tax rate is now assumed to be 24 to 26%, reflecting the maximum rate under the current tax law. Additionally, mortgage payments and interest charges are still calculated based on the original financing terms. We have this pro forma, and I think it's similar to the previous example. And I'm going to let you review this on your own. Modify it if you want. I'm not sure if I reconcile. I did not. You can do the addition and subtraction here if you feel like it. Again, this spreadsheet is available on every lesson, so you can go in and manipulate these numbers as you'd like. Here's our after-tax cash flow. When looking ahead over a 5-year forecast period, which translates to 10 years from the time of purchase, it's crucial to factor an after-tax cash flow as well. Assuming a 3% yearly rate of price appreciation, the owner predicts that the value of box should climb to $289 within that time frame. To determine what ATC, after-tax cash flow, might look like, refer to table 14.5. Keep in mind that both the mortgage balance and adjusted basis are calculated based on the entire 10-year, starting from the date of acquisition. Here is just the change in this sell process. Now, you can play around with these numbers. I did not, but you can reconcile them to this 9922. In deciding whether to sell a property, it's crucial to consider more than just its current market price. It's important to delve into other investment opportunities where the proceeds from the sale could be reinvested. Additionally, the tax implications of selling one property and purchasing another should be carefully examined. If the property is sold and the funds are reinvested elsewhere, the new investment must yield a return high enough to compensate potential loss and returns from selling the property. Key question becomes, what level of return must the alternative investment offer if the property is sold? If box is sold to acquire another property, capital gains and selling expenses most likely can be deferred. But here, we'll just play this game that they'll have to be paid before funds are available for reinvestment. So when debating the sale of one property and the purchase of another, first tasks facing the investor is to determine how much cash would be available for reinvestment should the box center be sold. The estimated sale price for the box center at this time is $250,000. However, the relevant data for the investor to consider is how much cash will be available for reinvestment after payment of the mortgage balance, taxes, and selling expenses. This is found by computing the after-tax cash flow as if the property were sold immediately, as we did before. We saw in table 14.2 that if the property were sold today, the investor would net $70,000 after repayment of the mortgage and payment of capital gains, etc. $70,000 would be available for reinvestment should the investor decide to sell box at this time. Note that capital gains rates are expected to remain at 24% through 2024. I'm not sure if that's accurate, but we'll just play along. Sell calculations should always be based on the tax law that are expected to be effective when the property is sold. In this case, for example, even though property was purchased at a time when a 32% capital gains exclusion was available, because the property is being sold under the new tax law, the capital gains exclusion may or not be in effect at the time of the reading. However, the maximum marginal tax rate has declined from 28% to approximately 24%. The owner must now consider whether or not the 70 grand can be reinvested at a greater rate of return than the return that would be earned if box were not sold. In other words, we want to know what the maximum after-tax internal rate of return would have been as an alternative investment equivalent risk to box to make the investor indifferent between continuing to own or selling and buying something else. The answer is relatively straightforward. We know that the cash available to reinvest the 70 grand is sold. Also, we know that if box is sold, the investor gives up the after-tax cash flow for the next 5 years and the after-tax cash flow of 92 grand at the end of the 5th year. So the 70 grand must generate a high enough return to offset the cash flow that would be lost by selling box. Cash flow summary and return calculation is as follows. All we're doing is taking these cash flows up here, right here, and then the 70 grand, and then this net, which was 107, which was the 92 in the 5th year cash flow. The bottom line, you're getting a 15.6 internal rate of return. Therefore, the investor would have to earn an after-tax rate of return greater than 15.6% on the funds obtained from the sale of the box center. These funds must be used to purchase some alternative investment equal in risk to justify selling box. In this case, if an alternative investment is equal in risk to box and the investor estimates that after-tax internal rate of return from the alternative investment would exceed 15.6%, then the sale of box and the acquisition of the alternative would be justified. If the after-tax return on the alternative investment is expected to be less, then box should be retained. Brad Williams, Frugal Finance. See you soon.